Hertz Global Holdings is in the midst of a significant turnaround, and its third quarter of 2025 results offer some of the clearest signs yet that the transformation is bearing fruit. For Q3, the company reported revenue of approximately $2.5 billion, representing a year-over-year decline of about 4%. But importantly, this result came in above consensus estimates. The company also swung to profitability on an adjusted basis, reporting earnings per share of about 12 cents versus the roughly 2-cent consensus, highlighting meaningful operational improvement. What's driving the improvement? Hertz's strategy is manifesting in distinct ways. First, fleet utilization rose to approximately 84%, up from what it had been previously, demonstrating stronger rental demand and better fleet management. Second, vehicle depreciation cost per unit per month, a key metric in the rental business, fell dramatically, reported to be around $273 per vehicle per month, representing a nearly 50% improvement year over year. These metrics point to the company's buy right, hold right, sell right fleet strategy. Improving economics, acquiring vehicles at favorable residual values, holding them shorter and selling them proactively, which frees up cash and lowers cost per unit. Additionally, Hertz is leaning into used car sales more aggressively, recasting part of its business model away from purely rental operations toward a hybrid mobility and asset monetization model. The firm also recently launched a fully online car buying marketplace and has deepened its partnership with Amazon.com Inc. for used vehicle sales, moves that diversify revenue and improve cash generation. These strategic actions help mitigate the softness in rental demand by capturing value in the resale market. On the fundamental side, Hertz's balance sheet and liquidity remain fully focused. The company ended the quarter with liquidity exceeding $2.2 billion, which provides a cushion given heavy capital and operational needs of a fleet-based business. While the company still carries significant debt and asset obligations, the reduction in depreciation cost per vehicle and the improved utilization rate give confidence that the business model is becoming more resilient. However, the challenges cannot be ignored. Hertz remains exposed to macroeconomic risk, weaker travel demand, corporate rental contraction, and consumer spending softness could weigh on utilization and revenue per day. The asset nature of the business, large fleet costs, depreciation, residual value risk, means any downturn in used car markets or unexpected residual value drops could quickly erode profitability. Also, the business is still in transformation. Rental fleet size is being managed downward for efficiency, but scaled growth remains uncertain. The margin structure is improving, but full return to strong profitability is not yet secured. From a technical analysis standpoint, Hertz's stock has been highly volatile. Unsurprising, given the turnaround narrative and the asset-heavy business model. Key technical levels include the 200-day moving average as a longer-term trend reference and the 50-day moving average as a nearer-term momentum signal. A sustained move above the 200-day average on increased volume would suggest that investor sentiment is shifting to a more positive regime. Conversely, a breakdown of recent support levels, especially after weak earnings or fleet value surprises, could trigger sharp downside, as sentiment and leverage both amplify risk in this name. Applying a SWOT lens, we see strengths. Hertz has a legacy brand in car rental, global footprint, operating in about 160 countries via various brands, and is executing a disciplined fleet refresh strategy that is reducing cost per unit and improving asset utilization. The used car marketplace initiative and partnership with Amazon signal diversification beyond core rental. Weaknesses. The company remains unprofitable overall, with scale reduced from pre-pandemic levels, and residual value risk per vehicle remains elevated. The asset-intensive nature of the business means depreciation, maintenance, and fleet financing weigh heavily until the turnaround is fully complete. Opportunity. If global travel recovers in full, business travel, international tourism, rental demand could accelerate. Used car sales sectors may become meaningful cash generators. Mobility services Given its improved metrics but remaining risk, the investment thesis is asymmetric. There is potential upside if the turnaround continues and executed fleet economics scale, but considerable downside if fleet asset values, utilization, or macro demand deteriorate. The stock today is more of a turnaround play than a stable business. Given all this, my recommendation is that Hertz is a speculative buy for investors who accept high risk, want exposure to recovery in travel and mobility, and believe in Hertz's asset monetization and fleet strategy. For more conservative investors, it would be prudent to wait for clearer signs of sustainable profitability, improving revenue per day, stronger cash flow, and a consistent upward move in utilization before scaling a position. In summary, Hertz is in a new phase. The rental car business is transforming into mobility plus asset monetization. The fleet rotation is improving economics, and used car sales are gaining strategic significance. If the company succeeds, it could reward investors significantly. If not, the risks are heightened. Time horizon, position sizing, and risk management matter greatly in this name.